The markets are in a holding pattern. Apparently, we are waiting for something to happen on this ultimatum that President Donald Trump issued to Iran about opening the Strait of Hormuz. And so there isn't conviction on the board for now. What's coming this week, and can we get some conviction? And can we figure out what in the world is actually going on here? That's what we're going to try to figure out right now. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And as ever, what we are going to do is first and foremost take a look at the price action, see what that is telling us about what is on the menu here. And from there, see if we can't figure out some next steps, because of course the key here is as ever, what is the price action whispering to us? Because certainly attempting to make sense of this news flow seems like a dangerous kind of an idea instantly, just because the markets are so headline sensitive that everything seems to be switching in rapid form. So let's first and foremost take a look at what the prices themselves are telling us. And from there, maybe we can make some sense of next steps. Here's the view on the bogey du jour, of course, crude oil prices here holding steady against the spike high that they hit when this whole episode began. And we can see here that we gap a little bit higher at the start of the week, but we don't end up actually going anywhere. We're just hovering. And so, on the one hand, there's conversations after an Axios report overnight that maybe there's a ceasefire being discussed. There are conversations about perhaps we are going to have the president make good on this ultimatum that he's made, where he very clearly said, listen, I'm not backing down from this one if Iran is not going to reopen the strait. And the deadline for that is essentially overnight here. If that's not met, then we're going to start to bomb all manner of energy infrastructure. The market seemingly not sure which way this goes, but they're pointedly not putting conviction behind that outcome or this one. So what we're seeing is the market is clearly unsure of whether the president means it, whether Iran is going to meet him halfway. They've certainly been sounding a defiant tone. Whether there is a ceasefire to be had, that Axios reports claimed that a whole range of countries are having these discussions, including the U.S. and Iran, and that Iran asked for this, which of course then raises the question as to who we're talking to and who is talking back when the president makes threats on social media. Because again, that defiant tone coming out of social media on the Iranian side ostensibly isn't the same group of people that's negotiating a ceasefire if that ceasefire negotiation is in fact occurring. So the fog of war is particularly dense at the moment, and the markets don't want to make a call this way or that. We can see the same thing from stock markets. They attempt to get a little bit of traction, but ultimately they're holding back at a familiar level. If ever there was a clear cut, if the trend stays, this has to hold. And if it's going to break, this is the spot. This is about as classic of a chart setup as you can imagine. This is the deciding one. And we'll recall there was something very similar here, for example, in this instance, where we had a clear band of former support become resistance. We broke through that. We gapped to test it, and ultimately the trend held. Once we came down to this support, we came back again into this same area. Couldn't hold it, broke down. We've retested the underside here before, broke down. We're retesting it again. Not unlike we tested this 2 times, one time closer, one time more distant. Now we've tested this one time closer, one time more distant. Let's see if it holds. But for the moment, the markets are not prepared to jettison the war trade as an idea. Same thing with the bonds. We can see they're also pointedly testing the former area of support that they broke, and they're not finding conviction to overturn what has been a trend toward lower bonds and higher interest rates since this thing began. Same thing for gold. And the trend motivated in the same way. Gold, of course, doesn't yield anything, and so is a natural foil for interest rates, and as an alternative store of value is also a natural foil for the dollar. Well, what have we had against the backdrop of this war, where the melt up in crude oil has given us what we just saw in the bonds here, right? Higher interest rates, born, of course, of inflation expectations surging. And what do we end up with? We end up with gold lower because, of course, higher rates don't do it any favors, but also a higher dollar, which also doesn't do it any favors. And so we end up with a situation here where the market is ostensibly looking at this and going, well, this whole thing in its sort of sum total is an inflation risk. Nothing that we've seen so far suggests it's become any less of an inflation risk. Maybe we are going to have some variety of change, of course, here eventually. But for the moment, this is the story that we're looking at, and the markets aren't prepared to let go of that narrative, even as we see the sort of fog of war really descend on markets and obfuscate whether maybe we have some on-ramp here. The hopium, in other words, is not strong here, but neither is the panic. It is worthwhile to mention, though, that the markets have had more hopes for an on-ramp than they appear to be entertaining now. And that's something to keep an eye on, of course, because as ever, this is the story. We can see clearly that the markets are looking at this situation through an inflationary lens, where when you have a run-up in oil, or indeed any kind of concerted move in oil, it would seem, the lag for that to appear in headline CPI inflation seems to be about a month. And what you end up seeing here then is everything that we just saw in the price action across the major assets kind of cascade from that idea that if you have this surge in oil, and if it becomes sticky, especially since if you were to reopen Hormuz in full today, it would take months in the best case for things to normalize, and normalize they maybe could, but the reality is we probably can't go back to the status quo before the war, because now if Iran is going to continue to have control of the Strait under this regime, they want to charge a toll. So that's baking in a higher price perpetually in perpetuity. If it's a capitulation and a new regime takes hold in Tehran, well, there's no telling what they'll do with the Strait and how quickly they can get everything back in order. And if it's the U.S. controlling the Strait, well, then who's to say that it's not going to get used as economic leverage, especially against China? So there is a whole range of options here, but none of them seem to end up with this not being an inflation shock, at least for some amount of time. And when we look at where the world was, this is as of January here, these are the OECD countries, and we can see that 50% of them were already looking at inflation rising before this war, even though, of course, inflation had normalized significantly since the COVID spikes. And by, let's call it the middle of 2020, 24 going into 2025, almost no country had rising inflation. Before this war, clearly it was a different story, but now it is almost certainly an inflationary risk, because whatever comes as a consequence of this war is going to come on top of what we're seeing here, which was already starting to become inflationary by itself. Now, of course, the counter argument is if this goes on long enough, the higher price of oil and the higher price of everything that is transacted through the strait, be it aluminum or helium or fertilizers or the petrochemicals that are needed for all manner of fertilizers and plastics and what have you. Something like 50% of global polyethylene, the most common plastic that really goes into almost everything you see around you, goes through the strait. So there is all kinds of an inflationary shock here beyond just energy. But of course, if you keep that squeeze long enough, people are going to start to say, well, we need to pay for those necessities that are now more expensive, like energy, like fertilizer, and we're going to, as an offset, start to claw back spending elsewhere. If it was a temporary shift, we'd just bite down and take the squeeze. But if it's going to last for a long time, well, then we need to make some more lasting adjustments to our spending patterns and pull spending from those things where it can be foregone to now cover these extra costs. And that kind of demand destruction has been starting to show up in inflation expectations. We can see here the 5 and 10-year break-even rates, which measure the inflation expectations baked into the bond market. They've started to come off recently, in particular at the longer end here, as crude oil has continued to march higher, even though, of course, the initial march in crude oil since the beginning of the year fed inflation expectations. And then, of course, the war amplified that by many orders of magnitude. And so we saw a surge in the violence of this crude oil move, and with it, the inflation run-up got another big shot in the arm. We now see these things diverging a little bit. And that could be because we're getting into that demand destruction risk part of the equation. And not surprisingly so, because just like 50% of OECD countries had rising inflation before this war began, so too 50% of them had rising unemployment rates. And so we were already in this uncomfortable location economically, where global economies were starting to feel the stress even as inflation was starting to perk up. Well, here it is, the overlay of overlays on this thing. With the war, both of those things get worse. Now, you wouldn't know it looking at U.S. employment data that came out on Friday. 178,000 jobs added to non-farm payrolls. That's well in excess of the 60K expected. The unemployment rate ticking down from 4.4 to 4.3%, reversing the rise in the prior month. But there is more than meets the eye here, it would seem. This is not exactly the rosy report that it appears to be at first blush. And you see that when you start to look under the surface. The actual tenor of these numbers is perhaps much more worrying than these headlines suggest. And you really get it when you start to look at the breakdown in the various subcomponents here. And what you see immediately is that the overwhelming majority of jobs here is once again coming from healthcare and education. And that isn't altogether unusual, because when you consider what this seems to say, it follows a familiar pattern. We know, looking from the recent history, certainly a couple months back and longer than that that this has been a structural sort of jobs growth. Take a look at the way back here. This is as far back as the data goes, about 3 years here. What you see is this pink area in the middle seems to be the largest one of the bunch. And that's, of course, education and healthcare services. Now, why is this consistently the biggest driver of employment growth? Well, rocket science, this is not. As of March, the U.S. hit the highest population of 55 years and older Americans on record. Unless you think that this is somehow proportionally matched by younger Americans, it isn't. We also hit the highest share at nearly 31% of the population for those Americans. So more, we're approaching a third, let's say, of Americans are now 55 years or older, the highest ever. These records go back at least to the 1950s, depending on which data you look at. And so when you consider what this means, well, of course, there's job creation in education and healthcare, in particular in healthcare. Somebody has to take care of these people. There's obviously a lot of demand here for services that target this cohort. Now, on the one hand, this means that job creation is not so cyclical. And so were there to be a big squeeze, these people 55 and over aren't going anywhere. And so you do need to still create the jobs that support them. On the other hand, it also means that everything in these other sectors is at best anemic. And so if there were to be some sort of a major economic shock, it wouldn't be very difficult to overwhelm the kind of structural baseline that occurs for this healthcare work job creation engine with all the losses that you might see were there to be a recession and a meaningful round of layoffs. And so it's, on one hand, a source of insulation for the job creation that there is now, to say that it is structural rather than cyclical. But on the other hand, the cyclical part is not exactly spread in an encouraging way. Most of it is modest, if anything. The second biggest job creator after education and healthcare services, for example, for March was leisure and hospitality, exactly the kind of thing where you might see people trade away to finance extra energy costs. And so encouraging, this is not. Now, we also got some ISM data from the Institute of Supply Management, a view on the service sector. And here, still looks like we have generally solid output growth. We come down a little bit from the heady levels that we saw in the prior month in February. That was, of course, the highest since back here in 2022. So very strong numbers, and a little bit of a pullback probably doesn't hurt here and probably makes a little bit of sense in context, but look under the surface and things look much more ominous. Employment contracts for the first time since the middle of last year. As ever, this is done in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so you can see here, this is perhaps the first time that you're below 50 since back here, call it latter day 2025, October, November, but it's also the fastest contraction since December of 2023. At the same time, costs are surging. The price component here flying higher and is now at the highest since, let's call it July or so of 2022, mid-2022. Very much still around that shock that we have on the prices front post-COVID. before the Fed's rate hikes that they start in March of that year really start to take hold and beat inflation back. So as we look under the surface, all of those risks, both to inflation and to employment and thereby to growth, all of them are materializing here. And we start to see how you get from an inflation shock to demand destruction, which is, of course, precisely the fear and precisely what the markets seem to be looking at here as we consider what comes next. Now, the biggest read-through from this, of course, is to what the Fed may do next. And here is perhaps the biggest risk for markets, because with the Fed's objectives seemingly in tension, we have a kind of rock and a hard place situation. From where the expectations sit currently, the markets don't expect any policy changes from the Fed this year, and they're flirting with the possibility of maybe one cut next year. That's not hysterical concern about demand destruction, but it's certainly a recognition that we don't have space for hikes or cuts this year because, on the one hand, the economy seems to be under threat. On the other, inflation is on the march. Now, we can see that even under these clouded circumstances, the stock market is responsive. As we've seen this surge in the policy outlook that erases rate cuts for 2026, the S&P 500 has come down. As you see the demand destruction part of the conversation start to come into the conversation at the beginning of this month, beginning of April, and coming out of March, as things get a little bit more dovish, as you start to put some rate cuts back into the mix for next year, stocks come back up a little. Now, there's a couple of things this week that are going to impact this closely. First, of course, is going to be minutes from the Fed's latest policy meeting. And we're going to see if this sit down, this is, of course, the March sit down, if reading the tea leaves there gives us any clue as to what the Fed might be biased towards, the sticky inflation or the demand destruction side of the equation. It seems like the vibe going into that meeting was inflation was the bigger worry. And of course, that is what the markets would be afraid of, because if the Fed is afraid of inflation, then whatever rate cuts are on the menu here may be too many. And if this starts to move back higher again, because you start to factor those out even for next year, well, then stocks probably get pressured lower. The next bit here is going to be the CPI report coming out Friday. And not surprisingly, we're looking for a big jump. 2.7% expected for the core, 3.3% expected for the headline. So a dramatic increase in inflation that's coming on the menu. Of course, that much seems clear from what we saw in our kind of mental map of how all of these things appear in sequence. First, you get the spike in crude oil, then a month later, you get the build in inflation, give or take. But the question really is going to be, do the markets expect the Fed to look through that? Or is this the kind of thing that, in simple terms, takes this down 33 basis points expectation for next year, which is basically one cut and a 50-50 chance for a second, and trim that back? And if it does, well, then we can see the implications. And of course, from there, cascade all of the other major assets. So if the story after these FOMC minutes and the CPI numbers this week end up being the Fed is concerned about inflation first and foremost, and the story from labor markets looks like the kind of thing where the Fed is going to justify doing something like that by numbers like this, even as what's happening under the surface is vulnerable and perhaps is already deteriorating if the ISM numbers are to be believed, well, then the read-through ends up stocks probably find a way to hold this level and come back in. Bonds probably find a way to hold this level and come back down. Gold probably follows suit. And of course, the dollar probably has legs to punch through this resistance. Now, with all of that in mind, the exposure that I have on the menu here, still very long the dollar against the Aussie, the pound, the euro, the Canadian dollar, and in my spot exposure against the yen. That 6J contract is just too big, so I use spot rather than the futures. I am still short the bonds at the middle of the yield curve and at the long end, looking for rates to go higher. Still short risk. In fact, I've just extended my maturities a bit here for both the NASDAQ. That's now 46 days out. S&P is now 53 days out. I still need to work out what I'm going to do with the Russell and probably push out that one as well. But still short risk, long oil with plenty of time on the docket, and looking for the higher interest rates, fewer Fed rate cuts, and all of the implications thereof to wash over the markets from here. And that is macro money for today and for this week. I'll be back next week. I'm out the rest of this week, though. The show is usually here Monday through Thursday after overtime. That's the show I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. Also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money returns next week. Live and on-demand recordings for the rest of this week. Happy trading.